Okay, good afternoon, Rick. So good to see you.
Good to see you, Jeff, as always.
Well, listen, a ton of market data has been coming out, and a lot of that data that we've been putting out into the marketplace through our partnership has been through the Investor Sentiment Survey. And I'd like to start with that because some really interesting numbers this time, seeing that investors' optimism has actually ticked up versus our last survey. What are your thoughts on that, Rick?
Yeah, it's really interesting. I guess if you're a real estate investor, you're probably a little bit of an optimist at heart. But we saw a pretty significant jump in perception from the spring to the fall. In the fall survey, 49% of the respondents said they believed that market conditions were better today than they were a year ago. That's compared to only 30% saying that back in the spring. And by the way, that matches some industry data we've seen from elsewhere that shows that the number of properties that were flipped in that quarter actually rebounded from a low the quarter before. So it might be that that investors are sensing things are getting better in the market and acting accordingly.
As investors sort of plan out at this stage, calendar year 2024, I found the sentiment survey extremely insightful as to what they felt the challenges were going forward. And of course, top of the list was financing, but there were a couple of other interesting items, such as lack of inventory, competition from institutional investors. What are your thoughts on that, Rick?
Really interesting that investors are citing challenges that are probably almost identical to the challenges you would get from a consumer who's looking to buy a property. We've seen financing costs more than double on a year-over-year basis, highest mortgage rates we've seen in 23 years. We see a lack of inventory, and those mortgage rates have a lot to do with that lack of inventory, because 2/3 of homeowners with a mortgage have a mortgage rate of 4% or less. And it makes it mathematically unfeasible for them to sell their house and take on, a new mortgage at 8%. And then the competition aspect is really interesting. If you talk to the investors who took our survey, they cite competition both from the institutional investors at the high end and from more traditional consumer home buyers at the low end. So in a lot of ways, these investors feel like they're getting squeezed, but they do feel like there's a lot of competition for those limited assets that are available today.
Sticking with the sentiment survey that we conduct quarterly for this proprietary data that we putting out, which by the way has been just tremendous. What I found interesting is investors today are more optimistic, as we just stated, but it seems like the overall consensus is we're not going to see the problems of 10 and 12 years ago with the Great Recession. And maybe that is actually bolstering some of their sentiment.
Yeah, the two things that most people remember and probably have PTSD about from the Great Recession are the home price crash and the foreclosure crisis. And both of those are definitely in the rearview mirror. We talked about extremely limited inventory of homes for sale. There's still pent-up demand, demographically driven demand for housing. And so that combination of really low inventory and fairly strong demand, even at these higher prices, is protecting prices. If you look at the Case-Shiller numbers, if you look at NAR numbers, if you look at data from the FHFA, which controls Fannie Mae and Freddie Mac, all of them are reporting year-over-year increase in prices for existing homes. So that ongoing demand, the growth of household formation due to demographics, the fact that prices are actually going up on a year-over-year basis and not down, and the fact that mortgage delinquencies and foreclosures are at much lower levels than historic norms, all suggest that the market dynamics today are wildly different than they were back in 2008, and probably is one of the reasons that investors are a little bit more optimistic than you might expect.
That's an interesting comment regarding household formation. And I think it's really a misunderstood number. Everybody thinks, well, the lack of inventory today is really going to keep folks from, pulling the trigger and going out and buying that new house. But when it comes to household formation, there is oftentimes a sense of urgency because that household needs to be formed, and the numbers tell the story.
Yeah, the inexorable march of time is a pretty big determinant when it comes to household formation. We have the largest number of young adults between the ages of 25 and 34 in the history of the United States. They all need to live somewhere, and increasingly they're not moving back home with mom and dad. Now we've had about 1 million rental units come online this year, and a lot of these young adults who would normally have been looking to buy a house have been priced out of the market because of high interest rates and high home prices. So they're renting instead, but nonetheless they are forming households. Anecdotally, personal anecdote, I have an adult son living at home. He and his fiance, now he just got engaged, are planning to get married next September. That's going to be a household formed as they start out on their new life, and they will almost certainly be a rental household, because living in California, where the median home sold last month went for $840,000, it's just about impossible for young professionals to start out as homeowners. So that's one of the reasons we continue to see a lot of migration between states, and from more expensive markets to less expensive markets within states, as these new households are formed and young professionals try and get themselves up and running.
Yeah, that's very interesting. And you mentioned multifamily there. There's been a lot of discussion about the number of Class A multifamily units that are coming onto the market. Maybe talk with our investor audience about, Class A and that sort of rent demographic and how that's going to be absorbed into the marketplace. Many of our investors are oftentimes renovating B and C properties because they see those opportunities. How will Class A's coming into the marketplace affect the overall market in multifamily?
Well, a lot of the inventory we talked about that's coming online this year, about 1 million units expected to come online, are Class A facilities. You have very little building for new facilities that are in the B and C category. They all come in at fairly high rent prices. They tend to be either attractive to those young professionals we've been talking about who are looking for a nice place, or people that are looking to move up into a nicer category of apartment. But I think from an investor perspective, a lot of those Class A facilities coming online are in large apartment complexes, tend to be the purview of very large investors. And so for the mid-sized and small investor, I do think there's going to be a lot of opportunity in Class B and Class C apartments. And there's going to be a lot of need for those apartments that kind of gets masked over when you look at all the building that's going on at the high end. Yeah. So I do think there's an opportunity there. And I think that opportunity spills over into the single family rental market, where we don't see a lot of new inventory coming online. But a lot of people who would normally be home buyers, again, have been priced out of today's market and would probably rather rent a house than rent another apartment or continue to rent the apartment they're in. Maybe they want to be in a school district for their kids that a home might be in. Maybe they'd just like more space because their family is growing. So I do think there's opportunities across the board in the rental market. Although I do tend to believe that Class A category is largely the purview of the largest of the institutional type of investors.
So as we're talking about household formation and where folks are going to live, now would probably be a good time to talk about the fact that the average homeowner today is now looking at an 8% plus, but it's hard for me to say, an 8% plus homeowner mortgage rate. Thoughts on this and where we go from here?
Yeah, you and I were talking before we started doing this online discussion about the bonds market, and yields have gone crazy in the bond market over the last quarter. And that's actually helped to inflate mortgage rates beyond what most of us thought they'd be doing by now. I believe if the bond market hadn't gone sideways in the last quarter, we might have started to see mortgage rates come down a bit. That 8% mortgage rate has been both a mathematical barrier for a lot of prospective buyers and a psychological barrier for a lot of buyers. And it's moving a lot of people out of the market where they might normally have been looking to buy. So it's also locking in place, untold thousands and thousands of homeowners who simply can't afford to trade in a 4% mortgage, sell their property, and then take on an 8% mortgage on another property. It would more than double their monthly payments. So that it's a sticking point. I don't think we'll see those rates start to come down meaningfully until the Federal Reserve announces that it's ended its current cycle of rate hikes, which I believe they're getting close to doing. I don't expect that we'll see a rate hike in November. There's a chance we'll see another modest rate hike from the Fed in December at that meeting, but there's also a possibility that they're done. And historically speaking, every time the Fed has announced that they're done raising rates on the Fed funds rate, we've started to see mortgage rates come back down. So consensus seems to be that the Fed's almost done, and we should start to see mortgage rates gradually work their way back down once the calendar turns and we're into 2024.
So, Rick, regarding the bond market, maybe just take a moment and explain to the audience how the bond market affects the homeowner, the Fannie Freddie traditional homeowner mortgage rate.
Yeah, without getting too inside baseball, the 30-year mortgage rate is loosely but obviously tied into the yields on the 10-year U.S. Treasury bond. Typically, there's about a 1.5 to 2 point difference between the yields on the 10-year U.S. Treasury bond and the rates on a 30-year fixed rate mortgage. So if we were talking about yields on a bond being 4%, the mortgage rate would probably be 5.5 to 6%. Because the market is building in more risk and volatility because they're not really sure what the Federal Reserve is going to do, and because there's a concern that when rates start to come back down, a lot of mortgages will be refinanced pretty quickly, they build in more of a cushion. So in today's market, there's about a 3 point gap between those yields and mortgage rates. So with those 10-year yields being about 5% now, which is the highest number we've seen in over a decade, mortgage rates are surpassing 8% for even the most qualified buyers. And it's just making affordability a real challenge for a lot of people.
No doubt about it. And since we're talking about listings and sort of home occupancy, recent data shows that we have the lowest existing home sales in decades. However, the interesting thing is we are seeing near record highs in new home construction sales. How is this possible?
Well, it's a great question. Reality is that there's very little inventory of existing homes available for sale, about a 2.5 month supply nationally and much lower in some markets. In a normal market, you'd have about a 6 month supply, and that's a balanced market for buyers and sellers. So there's not much to buy in the existing home market. On the new home market, there's an almost 7 month supply of homes available for sale. A lot of those are completed. A lot of those are under construction, but nearly completed. So there's more to buy, relatively speaking, in the new home market than there is in the existing home market. But the big difference is affordability. Existing homes, if you look at FHFA numbers, the prices are up about 4.6% on a year-over-year basis. So they were high last year, but they're a little bit higher this year. If you look at new homes, they're off about 14% in terms of prices this year compared to last year. So they're more affordable. And that's not because builders are discounting last year's inventory. They're building less expensive houses today, whether they're smaller, they're using less expensive materials or whatever. they're more affordable. And on top of that, a lot of the builders are coming to the closing table with cash, which they're using to buy points to lower mortgage rates. In fact, there was a builder in Colorado I noticed that was advertising mortgage rates as low as 4.9%. So they're literally coming into closing with tens of thousands of dollars and buying down mortgage rates to make these properties more affordable for buyers.
Yeah, that's got to make a huge difference. When a conventional buyer is going into the marketplace, and it's common knowledge that 8% is the number, and then they drive down the street and see a new subdivision with a sign out in front that says, finance your house here for 4.9%. Boy, that is a game changer.
Really is. So, I mean, your average or your median new home price is still going to be higher than your average or median existing home price. But, we've seen the impact of higher mortgage rates on affordability, and we've seen it really decimate the volume of sales. If you look at Mortgage Bankers Association numbers, purchase loan applications are off something like 25% year over year, off 45% from peak. So there's just less people that believe they can afford a house, and they believe that largely because of the cost of financing. If you're a new home builder and you can afford to make that kind of contribution to get mortgage rates down, makes that property much more affordable for the buyer.
Interesting. I saw a data point this week that the days on market of existing inventory are actually beginning to tick up. That seems a little suspicious to me.
Everything is relative. If you look at days on market today for home sales, they are ticking up from a year ago, but they're ticking up from timelines that were historically short. 2 years ago, you'd have properties selling in 7 days. A year ago, they might have been selling in 14 to 21 days. And today they're selling, somewhere between 21 and 30 days. Historically speaking, that's still really fast. It used to take 30 to 90 days, depending on where you are in the country and what price tier you were in. So the length of time properties are staying on the market is increasing a little bit, but it's still historically a pretty short timeline. But it's one of the reasons why some of the headlines you're seeing suggest that the inventory of homes for sale is ticking up a little bit. That's not an indication that we're getting more homes listed for sale. It's simply an indication that once those properties do get listed for sale, it takes them a little bit longer to clear.
Not a surprise with the cost of financing today and the difficult decision that potential homeowners have in finding the right existing home and being able to afford it.
Absolutely no surprise at all. It's very likely that we will end this year with below 4 million existing homes being sold. That'd be the lowest number we've seen probably since the early 2000s. We will probably see somewhere in the neighborhood of 650 to 675,000 new homes that are sold, probably a little higher than original estimates, but still off considerably from peak years. So it's not going to be a banner year in terms of sales volume. And the expectation, candidly, is that 2024 is going to look a lot like 2023, with probably flat home sales next year in terms of volume, and prices increasing maybe a tiny little bit in the existing home market, again, because of the supply and demand imbalance. But until we see mortgage rates come back down below 6, probably into the mid to low 5s, it just doesn't seem like we're going to have enough inventory of existing homes coming to market to facilitate higher volume of sales.
So, of course, investors are always looking for the next great opportunity. Always, how can I find the next house to renovate and put it into the marketplace for family to live in, or find the next house to be able to renovate and rent out to a family. And a source of those deals in the past has always been foreclosures. What are we seeing in the foreclosure market today?
Yeah, foreclosure activity has been down since the government put a moratorium in place and a mortgage forbearance program in place at the beginning of the COVID pandemic. Now, those programs have expired. So those government guardrails are off now. But foreclosure activity has been very slow to recover. In fact, this third quarter, we finally started to see an indication that foreclosure activity may be starting to approach normal levels again, and we might get back to normal levels of foreclosure activity in about the middle of 2024. Year to date, overall foreclosure activity has been running at about 60%. I saw a report from Adam Data that showed in the third quarter there was an increase in foreclosure activity of about 20% from the prior quarter and about 30% from the same quarter last year. And a lot of that activity was in foreclosure starts, so the beginning of the foreclosure process. So I think it's pretty likely that as we get into 2024, we will start to see a little bit more foreclosure inventory than we've seen in recent years.
So for the investors out there today, and they hear that foreclosures are going to begin ticking up, or maybe just getting back to where we were before, does this mean there's going to be more REOs, or is it more of the same?
Really glad you asked that question, Jeff, because it's important for investors to understand that this market cycle, when it comes to foreclosures, is extremely different from the last market cycle. When the foreclosure crisis hit, when the Great Recession hit back in 2008, there was a 13-month supply of homes available for sale. Prices were starting to go down. 15 million adjustable rate loans were all going bad at the same time, and we had prices just falling through the floor. So lenders couldn't get rid of these properties at foreclosure auctions because they couldn't take the loss, and ultimately wound up repossessing most of these foreclosure properties and then putting them on the market as REOs later. And that was where, as an investor, you were going to get your best deals. 180-degree difference this time around. We're seeing REO activity, bank repossessions, running at about 30% of pre-pandemic levels. And the reason for that is that borrowers who find themselves in financial distress when they get that first foreclosure notice are listing their properties for sale rather than waiting for the foreclosure auction. And they're successfully selling these properties. And the reason they can do that, the reason they are doing that, is because 88% of borrowers in foreclosure actually have at least 20% equity in their properties. So the only way for them to protect that equity and not lose it to a foreclosure sale is by selling the property before that foreclosure auction. So for investors in today's market, the message is pretty clear. If you want to be buying distressed properties, you're going to need to work directly with the home seller who's in some stage of financial distress, usually the earliest stage of foreclosure, and negotiate some sort of deal to buy the property at that point. Your second best option is to wait for the foreclosure auction. They're running at about 50% of the level they were prior to the pandemic. But your worst option of all is to wait for the bank repossessions because they're just not happening in large numbers. And because of all the equity those homeowners have, I don't expect to see REOs come back to pre-pandemic levels until at least 2025 at the earliest.
Well, this is no surprise. Anecdotally, we hear from investors all the time that the lack of inventory, both on the conventional side through MLS and some of the other court auctions and probate, the inventory is just not there. I guess what you're saying, Rick, is investors really need to double down on their various models that have worked for them today, because we're not returning to the old days.
We aren't. Look, there were something like 6 million people who lost a home to foreclosure in just a few years back during the Great Recession, and that was off the charts in terms of high volume. We're looking at far lower numbers today, and those numbers probably won't get back to pre-pandemic levels, which, by the way, were fairly low historically speaking too, until about the middle of next year. So waiting for that wave of foreclosures probably isn't going to be a good use of time. I've been telling investors what you really need to do is keep your eye out for people that need to sell. We're in a market right now where somebody who's thinking about selling or considering selling probably isn't going to do that because of the high interest rates and what that would do to their monthly mortgage payments. But you're looking for situations where there might be a divorce or a death in the family or a job loss. On a more positive side, you might be looking for newly married couples or people that are having kids and their families expanding, people with a job transfer. So there are opportunities out there, but again, you're going to have to do your due diligence, really do a lot more work at the exploratory level to find those opportunities for people that need to sell, not wait for people that are thinking about selling.
This opens up another interesting topic, which is just how much equity has been built up really since, when COVID started in the true American single family home, and the difference that we've seen in the past through the appreciation of the home and, quite frankly, people paying down their loans during COVID. What kind of equity are we looking out across America at today?
Yeah, depending on whose numbers you follow, we have somewhere between 28 and 30 trillion dollars worth of homeowner equity, which is an all-time high. In fact, a lot of people are wondering why more homeowners aren't tapping into the equity for other things, but we'll save that for another discussion. It's been a combination of a few things. In some cases, it is people that have been paying down their loans, but overwhelmingly, the reason we've seen equity soar in the last few years is because home prices have gone up. There was a commonly held belief, which has turned out not to be true, that home prices would crash just like they did back in 2008 to 2011 because they'd gotten too high. But they're holding up because of the supply and demand imbalance. So homeowners are sitting on an unusually high amount of equity, both in raw dollars and in percentages. Again, citing some reporting from Adam, they claim that about 50% of homeowners with a mortgage are what they call equity rich. And that means that their home is worth at least twice as much as what they owe on the mortgage. So it's a really unusual set of circumstances. Very few homeowners underwater, almost everybody with some equity. There's a small subset of the population that's at a little bit of risk if the economy goes sideways. And those are people that bought at the peak of the market back in 2022 with low down payment loans. FHA loans, VA loans, where you're looking at sometimes a 0 down payment, sometimes a 3.5% down payment. If those homeowners happen to be in markets where prices have gone down a little bit, markets like San Francisco or Austin or Seattle, so those folks could be a little vulnerable. Those properties could find their way back to market pretty quickly if we do have a little bit of a slowdown in the economy that costs people some jobs.
That's a great segue into maybe talking for just a few minutes about the economy overall. And certainly a question that our investors always have, especially with the number of investors that we have today that are buying single family homes, both for short-term rental and long-term rental. What they really want to know is, are my new tenants that I'm putting into these homes, are they going to be able to afford the rent for the long term? And of course, that always turns to what the overall economy is going to do. And are we entering the recession that's been predicted, not predicted, and now is maybe off again? Maybe share with our investors what your thoughts are on where the overall economy goes.
Well, if you were just coming into the market today and you took a snapshot of the economy and then you heard people talking about a recession, you'd think they were insane. The preliminary reports come in on Q3 GDP, gross domestic product, at 4.9% quarterly growth, which is really, really high. Economists had been predicting about 4.3%, but this jumped up from 2.1% last quarter to 4.9% this time, more than doubled. Now, the other perspective is that Q4 GDP is going to be significantly lower. That what we're seeing right now is a lot of end of summer spending from consumers, and consumer spending makes up 2/3 of the GDP. So as consumers pull back a little bit in the winter months, we might see the numbers come back down a bit. Unemployment still very, very low, about 3.8%. Long-term unemployment equally low. And there's actually still 1.5 open jobs available for everybody who's looking for work. So, the jobs market seems pretty stable too. There are a couple things for investors who are looking at rental properties to keep in mind. One is that when it comes to single family properties that are being rented, you tend to be dealing with a somewhat more financially stable tenant than if you're looking at a Class B or C apartment dweller. So those folks tend to be able to weather a little bit of a financial storm better than some of your other apartment tenants do. So that's one plus for people that are looking to invest in single family rental units. The other thing to think about, though, is that if we do enter a recession, and I still believe it's more likely than not that we will have a recession next year, the first wave of job losses almost always tends to be among the renter population. So you do have to keep that in mind if your tenants happen to be heavily skewed toward service industry kind of jobs or other market segments that might be vulnerable. That's something to keep in mind as you're doing your economic forecasting for your own investments as we move into next year. I mentioned that I still think a recession is more likely than not, and I keep pointing to two historic trends that suggest that might be the case, Jeff. One is every time since World War II, really, that the Federal Reserve has corrected late in the game, once inflation had kind of established itself, once inflation had gotten a little bit too high and too sticky, the Fed has had to overcorrect and ultimately steered us into a recession. So they've raised the Fed funds rate to combat inflation 11 times since World War II, and 8 of those times were very similar to this cycle, where they had to kind of overcorrect. They waited too long, and because of that, we wound up entering into a recession. The other historical data point is something called a yield curve inversion, and it's when yields on a long-term investment like the 10-year Treasury become lower than yields on a short-term investment like the 2-year Treasury. Usually, a short-term investment has a lower yield than a long-term investment because of the risk involved in longer-term investments and how long your investment's tied up and so forth and so on. But every now and then, the bond market senses a disturbance in the force, and those things switch places, and it's called a yield curve inversion. We've had one of those now for many months, a fairly significant one, and the last 7 times we've had a yield curve inversion, it's been followed by a recession. I don't see any particular reason why this 8th time would be different. The good news, such as it is that because the underlying economy is as strong as it is, if we do have a recession because of Fed policy, it's likely to be fairly short and fairly mild. So we shouldn't see rampant unemployment, probably not enough for rental investors to get too worried about.
Speaking of the overall economy, I keep hearing that credit card debt is going up, but I also hear another statistic that cash on hand in bank accounts is still well above trend overall. And how much of that is left over from COVID, anecdotal, but the reality is credit card balances going up and cash still on hand. It's going to be an interesting way that the overall thought of a recession plays out.
So 2 things. Credit card use surpassed $1 trillion for the first time ever last quarter. Very, very large number. And it did that at a time when credit card interest rates have gone through the ceiling because of the Fed activity in raising the Fed funds rate. So not at all unusual for somebody to see a 25, 26, 27, 28% interest rate on their credit cards. So there's a little bit of a red flag in seeing credit card use jump up at the same time as interest rates on those credit cards have jumped up. And it's a cautionary note because one wonders if people are tapping into those credit cards to do things like buy vacations or Taylor Swift tickets, or if they're using them to make ends meet, which would be a much worse case scenario. On the bank side of things, banks are still flush with cash. That's not the same as saying that households individually are flush with cash. In fact, the rate of savings among households has gone from an all-time high when the government was sending out stimulus checks during COVID to an all-time low about a year ago. They've recovered a little bit, but are still running below historically normal levels. That's another red flag in the economy because, again, it begs the question of if people are tapping into their savings to make ends meet in what's undoubtedly a high cost of living environment. So while the banks do have a bunch of cash on hand, partly because they're not sure what else to invest it in, I've seen some research that suggests that the average household today actually has more credit card debt than they have savings. So it's something to keep an eye on, and it's one of those things that I hope we don't find out exactly what the answer is, because if we do, it means we've hit a recession that's probably a little more severe than we were considering, and people are failing because they have that bad combination of high debt and low savings.
So I'm going to wrap up on a positive note,
Let's do
and
that.
that is single-family home appreciation. Certainly, going out of 2022 into 23, there was a lot of doom and gloom. There's no way we can possibly keep this going. Here we are. So maybe where are we going to finish out this year, housing appreciation? And what are your quick thoughts on next year?
So, I think fix and flip investors got an early sense of that. We were talking about the RCN investor sentiment survey for the fall. And flippers overwhelmingly were more positive on today's market and the outlook ahead than rental property investors were. And they're both fairly positive, but flippers much more so. And I believe one of the reasons for that is we got through June when home price appreciation was decelerating, and we saw things start to turn around. So June, July, August, September, we've seen prices on homes start to go back up again. So on a year-over-year basis, depending on whose numbers you're looking at, we're somewhere between 2.5% and 4.5% home price appreciation year over year. I think we're going to end the year somewhere in that range, probably somewhere in the neighborhood of maybe 4 to 5% home price appreciation for existing homes. New homes, the year over year numbers will actually go down, but again, it's because they're building less expensive homes. And as we go into next year, assuming that mortgage rates don't go down quickly, and assuming that we don't see a whole lot of inventory coming to market, I think we see a little bit of the same sort of activity next year that we've seen this year. So sales volume probably flat, maybe even slightly lower, but home prices going up probably between 1.5% and 2% on an annual basis. So a not terribly exciting year in 2024, but certainly not a crisis year either.
Rick, as always, so good to catch up with you. Look forward to seeing you again soon.
Thanks, Jeff. Talk soon.
See ya.